All right, everyone. Thanks for tuning in. I am Mark, aka Stock Market Jobber. So, back in action, was out of town for a few days, was taking my daughter up to visit a college. Well, actually, not visit, but to go to orientation. So, it's pretty cool, man. Very cool. So, I've kind of been out of touch with the markets over the last few days. So, let's go through them. Now, my this kind of analysis here is based on my background as an institution, and this is what we would talk about in our morning meetings. What looks like it's going to move, what looks like it's not going to move, where will the market give you a trading idea as opposed to just kind of coming up with your on your own. The market speak, if you can listen to its language, it really helps you be successful. How does the market speak to you? Well, by how it acts when it gets to certain price levels that are important and what the momentum is and so forth and so on. All right, so let's just jump right into it. So here's the S&P 500 ETF SPY. And I like to start out with this. The S&P 500 is the most important index on Wall Street. It's what most people follow. And fortunately for us, there are these ETFs that are called spiders, which is from Standard & Poor's Depository Receipt. So Standard & Poor's is one of the sponsors of these. So the family is called spiders. So it helps us out. It's not exactly like the S&P 500 or the various sectors we're going to look at, but it's close enough. Now, here is SPY, and I'm going to go to I don't know. Excuse me, everyone. I think being on those farms up there, I got some allergies going on. My daughter's going to school in Farmville, farm area. All right, now check this out. We've had this top on SPY around 443 since June, since the middle of June. Now, there's a reason why there's resistance there and why things that get to resistance tend to run into resistance again if they get to the same level. When a market's moving higher, there's not enough sellers or supply to fill all the demand or buy orders. So what happens? The buyers are forced to be willing to pay a premium if they want to get sellers into the market. They come into the market and say you're some institutional trader, you want to buy 100,000 shares or at 432, maybe you can only buy 10,000. Maybe the next 10,000 you got to pay 433 and so forth and so on. So this drives the market up. When we get to resistance, all of a sudden the tide changes for whatever reason. This is where the sellers come out of the woodwork and supply overcomes demand and we go lower. Same thing happened here. Why would something get to resistance and sell off like this? Well, because investors who want to sell are watching this thing trend higher. And when they notice, oh, gee, it's not trending higher anymore, they assume, rightfully so, that other sellers are coming into the market. That's why we're not moving higher anymore. All of a sudden, there's enough supply to satiate or to fill all of the demand. So the buyers no longer need to pay higher prices. Some of the sellers start to think, gee, there's other sellers coming into the market. They might undercut me, and the buyers are going to go to whoever is the person who's willing to sell at the lowest price. So I'm going to reduce my price. And then we get this snowball effect. So this isn't because of the debt ceiling or this or that. Things get to resistance and they sell off because of investor psychology, because anxious sellers. We get to support, it's the exact opposite. There are buyers who are looking to buy. They notice that the market's not going any lower. Now, I'm sure as you can deduce, a market that goes lower, there's not enough demand to absorb all the supply. So sellers have to offer their shares at a discount. And this forces a downtrend. So we got up here. Now, why is there resistance at a level that was resistance? Well, there are people who bought up here who regret doing so. And they sell themselves, man, I made a mistake. If this thing gets back up to around 443, I'm going to sell so I can get out at break even. So if you have enough remorseful buyers placing sell orders, the level that was a peak, it can be a peak again. All right. Look at all charts through the prism of what does it tell you about supply and demand. Now, let's just go through some of these big sectors here. I will be back at 8 o'clock tomorrow morning for our live stream. This is our tech sector, second biggest sector. Pretty darn neutral, right in the middle of a range. Momentum is neutral. We can see here how we have our principle that you need to focus on if you're going to be a good trader. About some price levels are more important than others. And the S&P 500 consists of 11 sectors. Different things drive the market at different times. As you can see, the tech sector is really not driving the market. It's been at the same price level now that it has been at for, pretty much about a month now. So tech was in the driver's seat for a while, but now it's just kind of neutral. Now notice here, support can turn into resistance. This is our buyer's remorse in a different way. People buy here and the price goes lower, and a lot of the people that bought say to themselves, man, I wish I didn't buy. The price is lower. I want to get out, but I want to get out at break even. So if you have remorseful buyers placing sell orders at the support level, if there's enough, the support converts into resistance. So buyer's remorse can turn support into resistance. Buyer's remorse can keep resistance intact for a while. Now, the second biggest sector in the market is healthcare, and I think that's what we really need to pay attention to. Okay. We had a break below this bottom end of this trading range. Trading range has got resistance on the top and support on the bottom. Broke down, made a kind of a little bit of a rebound, but we're not really back above this level. So will this buyer's remorse kick in? Will the people who bought here, is there enough of them that regret doing so that they are going to place their sell orders at the level they bought at? And so far for the past 2 days, yes, there has been. So while everyone's focused on artificial intelligence and whatever the next nano this or artificial intelligence is going to cover the world at, well, I think the important thing now to watch is the healthcare sector for reasons that I just explained. This is the second biggest sector in the market. If we don't get back above this support level, which became resistance because of buyer's remorse, there's a chance the sellers who want to sell start undercutting each other, and that's going to drive the price lower. So I was saying for a few days there, or maybe a week, the most important thing to watch is the financials. But now my focus is right here. But before I go, let's take a look at the financials. This is the financial sector. It's so great that we have these ETFs. Oh, and this is looking pretty strong, but it looks like it's a little bit overbought. So that's our two things to watch. Will healthcare rebound back above that important level? Are the financials overbought, stretched out? I don't know. We're going to have to let the market tell us what to do. But I will tell you this. If the financials start to reverse and healthcare doesn't get back above that important level, the broader market's going to go lower. Now, one thing I should show you is we can go to the Spider's an ETF, and we can go to the website, SSGA. So Standard & Poor's Depository Receipt. SSGA is State Street Global Advisors. That's who runs these ETFs. And we can go to our holdings, and we can see our sectors. So we looked at information technology. We look at healthcare. We look at financials. Let's just take a look at industrials. And in the institutional world, this is the type of stuff you do in the morning meeting. Wow, look at that. Now, this is overbought. This thing is overstretched. Overbought means it's trading at a level that's at an extreme above what would be its normal or typical trading range. This is important because it's going to draw sellers into the market. A lot of Wall Street trading strategies are based on this concept of reversion to the average. If we get overbought, it means we're above what would be the typical average. So sellers are going to be expecting a reversion, and people are going to be stepping into the market, and that could cause this to go lower. All right, so now we got some things to watch. We don't need to worry about tech this week. We need to pay attention to industrials and financials are very overbought, which means they could reverse. Healthcare is testing what is now a resistance level. And if it doesn't get above it, there's a good chance the sellers come into the market and just start knocking it lower. And these overbought sectors, that's going to draw sellers into the market, and they could start knocking the market lower. So the best traders, they let the market tell them what to do. Now the market's going to talk to us by how these particular sectors act. All right, everyone. Thank you so much for being in here. I hope to see you soon. As a matter of fact, I hope to see you tomorrow morning at 8 o'clock. I'm going to spend more time going through all this tonight, and I will see you tomorrow. Thanks, everyone.